Ever looked at a company's financial report and wondered, what secret sauce goes into those numbers? We're talking beyond the headlines, diving deep into the very rules that build financial information right from the ground up. Today, we're taking a deep dive into FRS 102. That's the financial reporting standard applicable in the UK and Republic of Ireland.
That's the one.
It's a foundational document, isn't it? Issued by the Financial Reporting Council, and it quietly dictates how countless entities, from your bustling local mid-sized business maybe, right up to larger private companies, how they present their financial health.
Yeah, and what's really fascinating here, I think, is that while it might sound, well, pretty dense, like a rule book, FRS 102 is actually designed to make financial reporting concise, practical even. Think of it as the UK and Ireland's tailor-made answer to global accounting standards for small and medium-sized businesses, but with its own unique flavor.
Right. And our mission for you, our curious listener, is to, unpack the most important nuggets, reveal some surprising facts maybe, and show you exactly why understanding this standard is perhaps a shortcut to being truly well-informed about the financial world. So, to kick us off, who exactly uses FRS 102?
Is it for every single company, big or small?
Not every company, no.
Yeah.
FRS 102 is really the go-to for entities that aren't using the full suite of International Financial Reporting Standards, IFRS.
Okay.
Nor are they, say, tiny microentities under FRS 105, or those using the Reduced Disclosure Framework, FRS 101. It's pretty much perfectly suited for what many would call small and medium-sized or private companies in the UK and Republic of Ireland.
So it gives them a framework that fits their scale.
Exactly. A clear, consolidated framework.
And it's not just a dry set of rules, right? You mentioned practical. There's a stated aim for this standard.
Absolutely. Its core aim is to provide financial reporting requirements that are succinct.
Succinct, okay. Yeah, and that's vital for striking a balance between, let's say, rigorous compliance and practical application for these businesses. It's actually based quite heavily on the IFRS for SMEs accounting standard, the international one, which first came out, back in 2009.
Right. Now, this is where it gets really interesting, I think.
Yeah.
There's this concept of qualifying entities within FRS 102. What's that about? Why does it matter?
Yes, a qualifying entity. Well, they get a bit of a break, you could say.
A break? How so?
They can take advantage of certain disclosure exemptions, meaning they don't have to provide quite as much detailed information in their financial statements. Things outlined in paragraphs 1.11 and 1.12.
Okay, less paperwork.
Sort of. The trade-off is they still have to follow the core rules for how they recognize and measure items in their books. That doesn't change.
I see.
But it's a smart move, really. It eases the burden for certain businesses while, still maintaining transparency, especially if they're part of a larger corporate group. They just need to be clear about which exemptions they've taken, and if they are part of a group, the name of their parent company and where you can get those consolidated statements.
Right. So practical benefits, but still accountable. Now, one of the most fascinating aspects of these standards is how they constantly evolve, isn't it?
Oh, definitely.
FRS 102 isn't static. It's been through some significant overhauls. What's maybe the biggest shift you've seen recently, or perhaps one that really changed things?
Well, a key one was the triennial review amendments back in 2017.
Okay, 2017.
Before that, businesses could sometimes claim an undue cost or effort exemption for certain things, like investment property or investments in associates, intangible assets from takeovers.
Meaning they didn't have to value them at fair value if it was too tricky.
Exactly, if it was deemed unduly costly or difficult. But that review actually removed some of those exemptions.
Remove them. So what does that mean for businesses now? Sounds like less flexibility.
Precisely. Less flexibility there, perhaps. The view from the FRC, the Financial Reporting Council, was that in the UK, businesses should generally be able to find a fair value for, say, their investment properties without it being prohibitively expensive. And the rationale was that this shift means financial statements now provide more decision-relevant information to users, better quality info.
Makes sense, even if it means a bit more effort for the company.
Exactly. It highlights that constant tension in accounting, doesn't it? Providing useful information versus the cost, the effort of getting it.
Yeah, that balancing act you mentioned. We also saw amendments, I think it was December 2020, reflecting the UK's exit from the European Union. How did that impact FRS 102, practically speaking?
Those were primarily about tidying things up, really. updating legal references within the standard to align with the new UK company law landscape post-Brexit.
So more technical.
Largely, yes. A necessary adaptation to reflect the new legal reality, making sure the standard remain legally sound and applicable from January 1st, 2021 onwards, mostly.
Got it. And then came the Periodic Review 2024 amendments in March 2024. That sounds quite recent and potentially quite impactful. What were the big headlines there?
This is a big one. Yes, very recent. It fully rewrote a foundational part of FRS 102, Section 2, the bit on concepts and pervasive principles.
We wrote it entirely.
Yes, to align it more closely with the big international accounting conceptual framework, the IASB's one. But perhaps even more significantly for day-to-day practice, it brought the definition and guidance on fair value measurement that's now Section 2A directly in line with a major international standard, IFRS 13.
Okay, and what does that mean in plain English? Fair value alignment.
It means fair value is now explicitly defined as a market-based measurement, not something specific to what your company intends to do with an asset or how you might value it internally.
Right, so it's not about my plans for it, it's about the market's view.
Exactly. Your intention to hold an asset or maybe settle liability in a certain way isn't relevant to its fair value measurement anymore. It's all about what other market participants would assume, what they would do.
That sounds like a fundamental shift in thinking for some businesses.
It is. For things like non-financial assets, say a building or machinery, it even considers its highest and best use.
Highest to best use.
Yeah, meaning what's physically possible, legally allowed, and financially feasible for that asset in the market. It really forces a company to look at its value through a broader, more external lens.
Wow. Plus, I heard there were reforms related to interest rates and even global tax within these updates. What does that tell us about how accounting standards have to adapt?
It just shows how dynamic these standards have to be, doesn't it? The interest rate benchmark reform amendments, for instance, were all about addressing how companies account for the big switch away from rates, like LIBOR.
Ah, the LIBOR transition.
Yes, which underpins so many financial contracts. There's even a practical shortcut allowed there sometimes. And then you've got new disclosure requirements related to Pillar 2 income tax.
Pillar 2. That's the global minimum tax thing.
That's the one. Part of a massive international effort to ensure large multinational corporations pay a minimum level of tax globally. So FRS 102 had to adapt to reflect that too.
It's a testament, really, to how FRS 102 keeps up with significant global financial and fiscal changes.
It has to. These things directly or indirectly impact UK and Irish businesses.
Let's maybe unpack that rewritten Section 2 a bit more, the concepts and pervasive principles. You said it's foundational. What are the big ideas there and why are they so crucial?
Well, this section is really the bedrock. It outlines the fundamental qualitative characteristics that financial information must have to be genuinely useful.
Okay, the must-haves.
And the two primary ones are relevance and faithful representation.
Relevance seems straightforward enough, but what does it really mean in this specific context?
Think about it this way. Relevant financial information is something that is capable of actually making a difference in the decisions people make using those accounts.
Making a difference.
Yeah, it helps you evaluate what happened in the past, what's happening now, or maybe what might happen in the future, or even just confirm or correct your previous assumptions. Information can be relevant, even if, some users might already be aware of it from other sources. If it could influence a decision, it's relevant.
Okay, makes sense. And faithful representation. How is that different from just being, say, accurate?
Good question. Faithful representation means the information accurately depicts the economic reality it purports to represent. It's about being complete, neutral, so unbiased, and free from material error.
Complete, neutral, free from error. Got it.
And for financial information to be truly useful, it also needs these enhancing characteristics. Comparability.
So I can compare company A to company B.
Exactly. Then, verifiability. Can someone else confirm this information? Timeliness. Is it recent enough to be useful? And finally, understandability. Can users actually make sense of it?
Right. Comparability, verifiability, timeliness, understandability. Those are the pillars then.
Pretty much, yes. The pillars supporting relevance and faithful representation.
So this raises an important question. How does all this kind of theoretical detail actually benefit someone just trying to understand a company's financials quickly?
Yeah.
Does it make it easier or harder?
Ultimately, it should lead to more confident decision-making for anyone using those financials. Investors, lenders, suppliers, even the company's own management making internal decisions.
Better decisions.
Yes, and that leads to more efficient capital markets because people can trust the information they're getting. Now, a financial statement can't possibly provide all information for every single user's needs,
Of course not.
but these principles guide what should be there to give you that crucial, true, and fair view.
Okay, so digging into definitions a bit more, what exactly is an asset and a liability under this FRS 102 framework? I always thought I knew, but you hear about nuances.
You're right, the definitions are quite precise. An asset is essentially a present economic resource that's controlled by the entity because of something that happened in the past.
Economic resource.
Yes.
So something that can produce value.
Exactly, something that has the potential to produce future economic benefits for the company. This could be rights over physical things like property, plant, equipment, inventory. Or it could be less tangible stuff like intellectual property, patents, that kind of thing.
Okay, and a liability.
A liability is a present obligation of the entity, an obligation to transfer an economic resource, usually cash, but maybe goods or services also as a result of past events.
It's an obligation.
Yes, and the key here is that the entity has, and this is the wording, no practical ability to avoid this obligation. It has to settle it.
No practical ability to avoid. So it's pretty certain.
Generally, yes. And it's not just legally enforceable debts like loans or supplier bills. It can also include constructive obligations.
Constructive obligations, what are those?
Those are obligations that arise perhaps from a company's established pattern of past practice or its published policies or specific statements it's made, where it's created a valid expectation in others that it will discharge those responsibilities even if there's no formal contract.
Ah, okay. So if a company always refunds faulty goods, even if not legally required, that could become a constructive obligation.
Potentially, yes, if it creates that valid expectation.
Interesting. And speaking of definitions and measurement, the difference between historical cost and current value for assets and liabilities seems like a major conceptual fork in the road.
It absolutely is. Historical cost is basically what you paid for it originally, plus any transaction costs.
Simple enough.
It is. It's simple, straightforward, easy to verify against invoices. But it might not be very relevant anymore if the value of that asset has changed significantly over time. Think about property bought 30 years ago.
Right, its historical cost might be meaningless today.
Precisely. Whereas current value, and particularly fair value, provides monetary information that's updated to reflect conditions at the measurement date, usually the balance sheet date.
And, as we discussed with the 2024 review updates.
Exactly. FRS 102 now makes it very clear. Fair value is explicitly a market-based measurement. It's not about your company's specific plans for that asset or liability. It's about what the broader market would do or pay.
So for a building, for instance.
It's about its highest and best use in the market, not just how you happen to be using it currently. It's a much more outward-looking valuation.
Okay, that distinction is really key. Now let's talk about the actual statements businesses produce using FRS 102. What's a core assessment every management team has to make that's absolutely fundamental to the entire report?
That would be the going concern assessment.
It's going concern. Right.
Management must assess the entity's ability to continue operating, to continue as a going concern for at least 12 months from the date the financial statements are authorized for issue.
At least 12 months out.
Yes. And if there are material uncertainties, significant doubts about whether it can continue, well, they have to disclose those uncertainties very clearly.
And if they actually can't prepare them on a going concern basis, if the company is likely to fold,
then they need to state that fact explicitly, say the accounts are not prepared on a going concern basis, and explain why, usually meaning they'd use a different basis, like a breakup basis. It's a fundamental signal to users about the entity's future viability. Basically, is the business expected to still be around this time next year?
A crucial piece of information. Let's pivot now to some specific interesting areas that maybe highlight FRS 102's practical approach or some surprising details. How does it handle small entities specifically, and perhaps a common real-world scenario, like director's loans?
Well, for small entities, FRS 102 itself, particularly Section 1A, offers simplified ways to present their balance sheet and income statement. Less detail required.
Okay, simplified formats.
Yes. But what's particularly notable, and I think a really classic example of the standard trying to be practical, is the accounting for directors' loans.
Ah, yes. The director lends money to their own company. Happens all the time in small businesses.
Exactly. Especially interest-free loans, perhaps from a director who is also the main shareholder. Now, previously, the strict rule was that these loans had to be measured at the present value of future payments, discounted at a market rate of interest.
Discounted at a market rate, even if it was interest-free.
Yes, because the theory was it implied a financing transaction with a hidden benefit. The lack of interest was like extra remuneration or a dividend in disguise, which frankly was often a complete nightmare to calculate for a small owner-managed business.
I can imagine. Trying to figure out a market rate for a loan to Dave's Plumbing Ltd. from Dave himself.
Precisely. The FRC, the standard setter, acknowledged this. They recognized that for small entities, especially when the same person is the employee, director, shareholder, and the lender, figuring out a comparable market rate for a similar loan was incredibly difficult, if not impossible.
So what's the solution now?
As a practical, proportionate solution, FRS 102 was amended. It now permits such loans specifically from a director who is a natural person and a shareholder, or a close family member of theirs, to be initially measured simply at the transaction price.
The transaction price, so the actual amount loaned.
Yes, the amount transferred. No need for that complex discounting using hypothetical market rates in that specific scenario. It's a very sensible, real-world adjustment that removes a huge administrative burden.
That's a fantastic example of the standards adapting to the reality of different business scales. What about financial instruments, another complex area? Do we get a similar pragmatic approach there for, say, other types of instruments, maybe the more complex ones?
It's interesting here. Section 11 of FRS 102 covers what it calls basic financial instruments, things like straightforward loans, trade receivables, payables.
The everyday stuff.
Mostly, yes. But then Section 12 covers other more complex financial instruments, maybe certain derivatives, asset-backed securities, that kind of thing.
Yeah, the more exotic stuff.
Potentially. And FRS 102 gives entities a choice here. Either they apply the rules in both Section 11 and Section 12 in full, or they can choose to apply the recognition and measurement rules of an older international standard, IAS 39.
They can still choose IAS 39, even though there's a newer international standard, IFR 9.
Yes, that option remains. It provides some continuity and perhaps avoids complexity for entities already familiar with IAS 39. And here's another perhaps surprising bit of flexibility. FRS 102 actually permits a voluntary discontinuation of hedge accounting.
Hold on, hedge accounting. What is that exactly, and why is it surprising to be able to just stop doing it?
Okay, so hedge accounting is basically a special set of rules companies can use when they're managing financial risks. For example, if they use a derivative, like a forward currency contract, to offset the risk of exchange rate changes on a future sale.
Right, they're hedging their bets.
Exactly. Hedge accounting aims to make the profit or loss impact of the hedging instrument match the impact of the item being hedged in the accounts. Now, under the big international standards like IFRS 9, once you designate something as a hedge, the rules for stopping are quite strict.
Ah, okay.
But FRS 102 is actually more permissive. It allows companies to voluntarily stop applying hedge accounting prospectively, even if the original hedging relationship still exists. It gives them a bit more control and flexibility, which can be useful.
Interesting. More flexibility than the global standard there. Now, you mentioned leases earlier. What on earth is a Peppercorn lease, and how does FRS 102 deal with that quirky situation?
Yes, a Peppercorn lease. It's exactly what it sounds like, almost. It's a lease where the rent is nil, or just a nominal, like 1 peppercorn a year, symbolically. Basically, a lease at little or no actual cost.
Okay, so someone gets use of an asset for free, or next to free. How is that a lease, then?
Well, that's the point. The FRC looked at this and concluded that if the payment, the consideration, isn't substantive, it's actually unlikely to meet the proper definition of a lease under FRS 102's Section 20, which deals with leases.
So it's not treated as a lease at all. That seems really counterintuitive.
It does, doesn't it? But the logic is, if you're not paying anything meaningful, it's not really a lease contract in substance. Instead, these arrangements are viewed essentially as a form of donation.
A donation.
Yes, so they should be accounted for under Section 34, specialized activities, specifically the part that deals with incoming resources from non-exchange transactions, like receiving a grant or donation.
So how does that work? Do you just ignore the asset you're using for free?
No, you recognize the right of use asset, but the credit entry isn't a lease liability. Instead, you recognize income like a donation received, which effectively offsets the cost of setting up the asset on your balance sheet. It reflects the reality that the asset's value to you is much higher than the minimal rent payments would suggest.
Wow. That's about looking at the substance over the legal form, isn't it?
Absolutely. It's a core principle.
Speaking of specialized activities, FRS 102 has that whole Section 34 for them. What kind of diverse areas does it cover besides peppercorn leases disguised as donations?
Oh, Section 34 covers a really wide, fascinating range of industries and specific activities. You've got agricultural activities, farming, forestry, extractive activities, mining, oil and gas exploration, where it actually points you to use IFRS 6.
Okay.
Then there are service concession arrangements, think public-private partnerships like building and operating a toll road. Financial institutions get specific guidance too. Retirement benefit plans, even things like heritage assets.
Heritage assets.
Right.
Like castles or museum collections.
Exactly. Things held for their contribution to knowledge and culture rather than purely for generating cash. FRS 102 says you generally account for them under other sections like property, plant, and equipment, Section 17, or intangible assets, Section 18, depending on their nature.
But they're flagged somehow.
Yes, they have to be presented separately on the face of the balance sheet or in the notes, acknowledging their special character.
Okay. What else is in Section 34?
Funding commitments promises to provide resources in the future, and those incoming resources from non-exchange transactions we just talked about. For funding commitments, a liability is only recognized if there's a definite present obligation that the entity cannot realistically withdraw from, and the other party's entitlement isn't dependent on their future performance.
So it's more than just saying, we intend to donate.
Much more. There has to be a binding obligation, effectively.
Right. Okay, one last specific area. Related party disclosures. This sounds important for transparency. Does the situation where, say, a director's spouse provides services to the company come up? How does FRS 102 ensure we know about these deals?
Yes, this is crucial for transparency. A related party transaction is defined very broadly. It's any transfer of resources, services, or obligations between the reporting entity and a related party.
And who counts as a related party?
It includes key management personnel, directors, their close family members, entities controlled or significantly influenced by them, and so on. The definition is quite detailed in Section 33.
Okay.
And the key point is a transaction needs disclosure regardless of whether a price is charged. Even free use of assets between related parties counts.
Regardless of price. And what's changed recently for small entities here? I heard there was a shift.
There was a very significant shift with the Periodic Review 2024 amendments. For UK small entities applying Section 1A, they are now required to disclose all material-related party transactions that they haven't eliminated in consolidation, subject only to a couple of very specific general exemptions.
All of them. That sounds like a big increase in disclosure.
It is. Previously, small entities only had to disclose related party transactions that were not conducted under normal market conditions.
Ah, which sounds very subjective.
Yeah.
How do you prove normal market conditions?
Exactly. It involved a lot of subjective judgment and was often difficult to apply consistently. Now the requirement is much clearer, much more objective. Disclose all material transactions with specified related parties. Full stop. Provide details about the nature of the relationship, the transaction, and the amounts involved.
So, simpler to apply, but definitely boosts transparency.
Absolutely. It's a cleaner approach that significantly enhances transparency for anyone reading those small company accounts.
So, after digging into all this, what does this all mean for you, the listener, the learner, trying to navigate the world of financial information?
Well, I think this deep dive into FRS 102 really shows that accounting standards are far from just being some static, dusty collection of rigid rules. They're constantly evolving frameworks. They're always trying to strike that balance, the need for relevant information, faithfully represented information, against the practicalities of actually implementing these rules for a really diverse range of companies.
Yeah, we've definitely seen that balancing act. We've seen how core concepts like fair value get refined over time to better reflect market realities.
Sure.
How pragmatic, real-world solutions get introduced for small entities wrestling with things like director's loans, and how even seemingly simple arrangements like those peppercorn leases actually have deeper accounting considerations based on substance. It's all driving towards that goal of a true and fair view, isn't it?
Exactly. A true and fair view of a business's financial position, its assets and liabilities, and its financial performance, its profit or loss. And the constant reviews, the triennial reviews, the periodic reviews, the amendments, they just underline that financial reporting is like a living language. It has to adapt to new economic realities, new business practices, changing legal requirements, and even the practical challenges that businesses face on the ground.
Okay, so here's a final, perhaps provocative thought for you to mull over based on everything we've discussed. Given all the detailed definitions, the principles, the specific rules within FRS 102, do you think companies, whether they're large or small, truly grasp the spirit of financial reporting beyond just, ticking the compliance boxes?
Or does the sheer volume of rules, the complexity we've touched on, sometimes risk obscuring that core objective, which is to provide genuinely useful, understandable, and transparent information to everyone who needs it? Something to think about. We hope this deep dive has given you a much clearer picture of the intricate and frankly quite fascinating world of financial reporting under FRS 102. And maybe it's even sparked some new questions for you. Until next time, keep digging for those insights.